Okay, we'll continue. Part 2. We have seen until here now. Okay, cost of carry model 2. I told you there are 4 types of cost of carry depending on the properties of the underlying. Forward price for an asset that pays no income. Earlier we saw the forward price of an asset with no income. Now if there is an income, what happens? For example, like dividends or coupon or something like that. If the security pays a known income, then you have to present value that particular income, because the income comes at a certain timeline between the initiation 0 and the time big T. This can happen, it can be a 6 months contract, and this present value of the dividend could be 3 months from now. So you have to present value it to 0 first. So present value of the dividend, for example, we use the term I using the intuitive explanation that a cost of carry model. The short seller gets the compensated by financing cost less income paid by the holding asset. So I told you just now, cost of carry itself has got 2 components. That is, one part is the cost, additional cost that involved from the S0 must minus from whatever income received. And the income received could be immediately at S0 itself, or it could be somewhere in between the F0 time until the big T maturity time. And you have to see what is the timelines carefully. So in other words, cost of carry in this case is financing cost minus the present value of their income. That is, F0 equals to S0 minus the I from the S0 before you calculate the exponential rate of it. This version of cost of carry model is applied to forward return on stocks that paying a known dividend anytime between the time of the inception of the forward contract until the forward contract matures. If you receive a dividend after that, there is nothing to consider. If you are receiving any dividend between the inception time 0 till the big T, the maturity time, anytime, sometimes it can be 1 dividend, sometimes it can be 2 dividends also, or forward return on coupon paying bonds and the coupon matures in between. So let us see some examples on this. So consider a forward contract on a bond. Suppose that the bond price today is $95 S0. It's quoted. Contract length is 6 months. T is 6 months. Interest rate R is 10% per annum, continuously compounded for all maturities. Coupon is 5%. When you will be receiving? Coupon of 5% will be receiving in 3 months. Oh my God, that is between 0 and T is 6 months, but you are receiving somewhere exactly in 3 months. There's an in-between sub-period receivable. So what is the fair value of this bond? So now we'll calculate. Now, the coupon is $5, is the holding benefit for now. So we use the letter M to determine this. You know, I is for any other income, M for this kind of coupon is the present value of the $5 receivable in 3 months. So the rate is given as 10%. Now 3 months from now to there is 2.25%. So M equals to 5 exponential to minus, because you are discounting it to today, minus 0.1 times 0.25 equals to 4.88. Today's value of that receivable $5 in 3 months is 4.88. Thus the arbitrage fee, if arbitrage free forward F0 must, or the theoretical price of the F0 must satisfy this, that F0 equals to the ERT can be either behind or front, S0 minus M, that is E in the 0. Here you are compounding it, be careful. Students get confused here. Here you are discounting the $5. Here you are compounding the value to 6 months. So e to the power of 0.1 times 6 months, because the contract of this particular bond is expiring in 6 months. And the value to be exponentially calculated is $95 the S0 minus the income of 4.88. There's no other holding cost. So it should be giving you the rightful price, supposed to be 94.74. $94.74 is the rightful forward price of this particular bond. Although the S0 is 95, because you're receiving some money, that is the coupon will be received. So that reduces the value to 94.74. Okay. So any other quoted forward price, either higher or lower, tend to lead to an arbitrage. That's what we have been discussing earlier. Therefore, a time T0 now, S0 equals to $95. F0 should be 94.74. If the F0 quoted today on this bond is anything else other than 94.74, even if it's quoted as 95 also, it is wrong. Not say wrong, it will lead to an arbitrage. It's mispriced. Okay. We'll continue with that example. Based on the previous example, suppose the quoted price is 98. Wow. Thinking that there is a coupon is coming and all that, and the price is 98. That is the quoted price in the market. Given the fair value or fair forward price or the non-arbitrageable price or the theoretical price calculated earlier should be 94.74. S0 is 95, don't forget. Then the forward is overvalued. Why? Because $98 is definitely more than 94.74 relative to the spot. So we should sell the forward because forward is overpriced, overvalued. Borrow to buy the spot. Can you understand now? Between the forward and spot. Forward is overpriced. Sell it. Spot is underpriced. Buy it. So always assume there is no money with you. Borrow to buy. Okay? Always assume your pockets are empty. Buying and holding the spot asset leads to a cash outflow of $95 today, because S0 is 25, but we will receive a coupon of $5 in 3 months. Therefore, there are a few ways to structure this strategy. Here is one of them. We split the initial borrowing of 95 into two parts. We pay in 3 months that $5 as you receive, and we pay the balance in 6 months. So that $95 which you are borrowing to buy the spot today, $5 you will pay in 3 months. $90 you will pay in 6 months. So what's the value today of this both? One part is repaid in 3 months, that is a $5 coupon. The balance is paid in 6 months' time. Let us see how we strategize. So the full arbitrage strategy is that enter a short forward. You sell the forward with a delivery price of $98. Cash will be realized at maturity. Buy the bond for $95 in the spot and hold it for 6 months. How to finance the purchase of this $95? Borrow 4.88 now, so in 3 months' time you pay back as $5. You don't go and borrow $5 now, Why? Because if you borrow $5 now, you will be paying more than $5 in 3 months' time. Who is going to pay you the difference? So you borrow the present value of that $5 at 10% for 3 months. It will come to $4.88. You borrow $4.88 and balance $90.12 you borrow for 6 months, where you will be repaying as $94.74. It will tally very correctly because that time value of money works like that. In 3 months' time, you receive the coupon of $5 and you pay the $5, repay the 3-month borrowing with interest. In 6 months' time, deliver the bond and receive $98 because you are selling it, right? You're selling it for $98. Repay the 6-month borrowing with the interest at 94.74. So the difference of $3.36, how you get is $98 minus 94.74 is yours. Your arbitrageable profit, which you are strategizing now. So I told you, arbitrages don't exist or persist too long. You have to quickly calculate now and show that there is an arbitrage profit. Immediately take action. Okay, so how do you put it into a table? Always I will ask you to write a table, draw a table to show this. So the cash flows of current time T0, cash flows in 3 months, and cash flows in 6 months at the terminal. So short forward for 6 months. You are not receiving anything now, you are not receiving anything in 3 months, you will be receiving $98 at the terminal time in 6 months, and you minus the ST because we don't know what will be the spot price the day, we leave it as a variable. Long the bond, spot $95 minus $95 you are paying now, you are not receiving anything there, and finally it will be ST, we don't know. Receive the coupon in 3 months, $5. You have borrowed $4.88 now, you pay back that as $5. 6 month borrowing was of $90.12. With the interest now that you will pay 94.74 at the end of the period. So you receive $98 minus ST and ST goes off, minus $94.74 for your repayment of the 6 month borrowing, because the 3 month borrowing you already settled here. So the net cash inflow for you The arbitrageable profit here is $3.26. Can you get that? Very easy. Sometimes you may have two sub periods here also. You may have 3 months and then 6 months for a 9-month contract. Or if it can be a 1-year contract also. The terminal could be even after 12 months. In between, you may have 1 or 2 dividends received. You have to be very careful in, even now, I draw a timeline. The best way is to draw a timeline and see when what's happening. Easy. Understand that? Okay, we continue. We have seen how to calculate when there is a definitely income. Okay, how to do an arbitrage on this? Okay, we already calculated this. You have done this table. Okay, for another example, consider a 10-month forward contract on a $50 stock that pays $2 dividend in 6 months' time. Continuously compounded risk-free interest rate is 8% for all maturities. And what should be the theoretical price of this trade forward to be traded? So you know you're going to receive $2 in 6 months' time. First discount it. I equals to $2 exponential to minus 0.08 is 8% times 0.5 because you'll be receiving in 6 months' time. So it is $2 times this calculation together with the exponent is 0.9608 become $1.92. So therefore, the F0 supposed to be $50 is the S0 today minus 1.92. Compound it for 10 months because it's a 10-month forward contract. Be careful on that. 0.08 is the 8% times 10 over 12 goes to $48. 48.08 times this exponential calculation. $51.39 supposed to be the today's price of the forward on this particular stock. That's how you calculate. So how to see there's any arbitrage opportunity? What if the forward price of this stock is quoted as 50? Of course, S0 is 50. If F0 is also 50, there is something wrong. You have to always calculate what is the rightful price. So the rightful price supposed to be $51.39. So $50 is below $51.39, so it's underpriced. So when it's underpriced, undervalued, or underpriced or undervalued is same. Therefore, we buy the forward and sell the spot. Long forward, at time T0 nothing. At time maturity is ST minus 50. You see, by you are buying, you have to pay the 50 there. There's no such thing as minus 50 plus ST, no. This is ST minus 50. Short the spot, sell the spot, you get $50 now. That could be a minus ST at that time. Pay the present value of the dividend because you are shorting. You have to pay. I told you, if you receive any dividend and you are in a short position, that dividend doesn't belong to you. You have to pay to somebody else who is the original owner. So minus 1.92, the present value of the $2. Invest the balance here. This is where the question comes. How come you got a 46.78? You have to invest the present value of the $50. This is not the difference here. Please don't assume 50 minus 1.92 is wrong. No. You present value the $50 to today. How much you should invest today so that you get exactly $50 there to pay for this. Okay. There are two ways of calculating this. I'll explain to you. So if you present value to today, you get 46.78. So 50 minus 1.92 minus 46.78, you get $1.30. But if you would have calculated it the other way around, that you got the $50 here, and you invest the $50 here, you should be getting more here. How much you should be getting here? You should be getting 51.39. You'll get 51.39 here. But here, of course, you won't invest the $50. Maybe the $50 minus 1.92, you invest the difference here, you will get something a little bit more than $50. That will be the difference here. That the difference can either come here as 1.3 or 1 point something here. If you discount it back to here, it will become to 1.3. You can calculate either way. I'll show you in the tutorials later. Okay, don't be confused. Okay, forward price for asset that pays not in dollars but in a yield. Usually, like stock index, you may receive dividend. There is no one particular stock to say this much a dividend for this. There will be a kind of a yield that will be given expressed in terms of percentage. If the security pays a known income which is expressed in terms of a yield Q instead of a dollar amount, the cost of carry model becomes F0 equals S0 exponential to R minus Q, assuming that the Q is lower than the R times by T. If the Q is more than R, then this equation can't work. And normally we won't give that kind of a calculation to you. Example, suppose that the risk-free interest rate is 10% per annum with continuous compounding and that the dividend yield on the stock is 4% per annum. Okay, the dividend yield. Currently the index is trading at 400. Calculate the forward price of this contract deliverable in 4 months. So the basic calculation F0 equals S0 exponential to R minus Q times T. That's 400. Now it stands at 400. Exponential to 0.1 is the 10%. Minus 0.04 is the yield. Times by 4 over 12 because it is going to be delivered in 4 months. So it should be $408.08. This is a very simple calculation. But sometimes it can be confusing because there is a yield, there is a per annum interest and all these things. Ponder this carefully. I will post some questions in the tutorial. We'll discuss it there. Okay, forward price for an asset that incurs storage costs. This is the very basic one, as I told you originally. If there is a known storage cost, and when does the storage cost happening? Whether it's going to happen throughout, or is it going to happen at a certain given time, or is it at the initial point, or is it the end point, or in between? If the security incurs a known storage cost, the storage cost can be treated as a negative income and that can be added to the current spot price. We use the word U here. Sometimes any other alphabet also can be used as a variable. Is the present value of all storage costs during the life of the forward contract. The cost of carry models become F0 equals S0 plus U exponent to RT. If the cost is expressed as a percentage of spot price, the cost of carry model is F0 equals S0 exponential to R plus U times T if it is given as a percentage. If it's given in a dollar form, you can straight away add here. That's the difference here. Okay. Now, consider a 1-year gold forward contract is currently priced at $500 per ounce. It costs $20 per ounce to store gold, and when is it payable? The cost is payable at the end of each year. So at the end, it's a 1-year forward contract, and you pay the storage cost at the end of the year. So risk-free interest rate is 7%, continuously compoundable. Risk-free interest rate is 7%. What should be the 1-year forward contract of this gold per ounce? So first you calculate the U. $20 discounted at 7% because it's 1 year, no time there, 1 year, times by 1 is always same. Discounted now is $18.65. So you add the $18.65 to the present $500 per ounce. So 500 plus 18.65. Then you exponent it for 1 year because there is no fractions of the time because it's 1 year. Compound it to 7%. So times it by 1.0725 equals to $556.25. That is the rightful theoretical price of this particular gold forward contract. Isn't it easy? It's very simple, straightforward. Okay, if we observe F0 to be 520 instead, we already calculated earlier, it's supposed to be 556.25, and if it's quoted as 520, it implies that F0 is lower than this, so the forward is undervalued. So when the forward is undervalued, what do you do? Buy the undervalued, sell the overvalued, always. So long forward, you are paying ST minus 520 here. Short the spot, you get 500. Here is minus ST. Save the storage cost because you sold it, so you are not storing it, right? $18.65 is saved here. Okay, so this one you need to receive 520 when you pay here. You see, long forward, you are buying in forward, you need 520 here. You're going to pay there, you need 520 here. So you, what you call is, you look at what is the present value. 500 plus 518, you receive the spot, short spot, and you have saved the cost here. You get the difference. So let it be there, but you just calculate the present value of this 520 minus 484.84. So this is where 500 plus 18.65 minus this, you get $33.81 as your arbitrageable profit here. But instead you want to calculate the difference to be this side. It's easy. That you invest this 500. You take the 500 plus 518.65. You invest the 518.65 here. With the compounding, you will receive something big. So minus 520, you will get the difference here. That difference, if you discount it, you will come back to 33.81. You try it and see when you are free. Okay, right. Okay, now the final part. Let us see the final part. Another example. Okay. Okay, the fourth cost of carry, I told you four models. The fourth one, forward price for an asset held for consumption. You already booked it in forward and you're using it little by little by little. There are cases where commodities are held for consumption purposes, example, oil refiners hold crude oil for production, or even like Air Asia, they book a few barrels of jet fuel in forward and start using little by little as they fly. Ownership of the physical asset enables manufacturers to keep production processing running and or profit from the temporary storage, something futures cannot do, where you can take delivery little by little by little. Of course, you can talk about a forward price of 1 year on a certain amount of stock, and you can use it while waiting for it. This benefit of holding physical asset instead of long forward is referred as conveniencing yield. Convenience yield is that there's a benefit in you booking at a forward price, especially if the forward price where the spot price of that particular underlying becomes very expensive at that time, you would have used it at the fixed price, which is benefiting you. Convenience yield measures the extent to which there are benefits obtaining from the ownership of physical asset that are not obtained by owners of the long futures contract. Cost of carry in such a case is interest cost plus storage cost less than income earned. So normally it is given as a yield. We use it as a Y. The convincing yield is a percentage. So S0 plus U, that is the carriage cost, the normal carriage cost, exponential to R minus Y provided the Y is smaller than R times T. If it's all given in, even if the U is given as a percentage, then the entire thing becomes S0 to exponential to R plus U minus T minus Y. So I don't have a good example to show you here, but hopefully I can put something in the tutorial and discuss. Okay, finally, does the cost of carry model hold in reality? You see, when we create a model like this supporting a theory, cost of carry model supporting the theory of forward pricing, we had so many assumptions there. So when you drop all these assumptions, in reality may not hold. Not exactly due to market frictions. That is, transaction cost is there. You cannot say, oh, assume there is no transaction cost. The ability to borrow assets to short, especially commodities, quite impossible. If you want to do short selling, you can by contract only. But if you want to borrow it physically and sell it now, is not possible. The ability to execute various transactions simultaneously. In the case of stock index arbitrage, as I told you, arbitrage you have to take simultaneous trading, buy and sell immediately. Sometimes it's not possible. So many empirical research has showed that cost of carry model does not really hold, is violated around 15% of the times. But we are using it as a model because somehow the theory supports that. We can do, like you go to the bank and say, today US dollars is 4 ringgit and 25 cents per US dollars. Can you give me a forward rate for 6 months from today? They'll calculate and tell you a forward rate. This is what you are transacting. So you feel that you have already booked the US dollars at a certain transacted forward rate. At that time, the bank may look at the spot price on the day for US dollars, could be higher or could be lower. Always there will be some difference. It's very difficult to say that, oh, my theoretical price what I've calculated is the right one. But anyway, you have to study that to show that theoretically there is something like that. Okay, that's the end of this lecture. Hopefully you all understand this. In case of anything, we can discuss in the tutorial next week, as well as consultation this Thursday. Still students are emailing me asking, I forgot to ask you this, forgot to ask you that. Asking me to teach in the email is very difficult. How to explain extensively in an email? Please come for consultation. Thank you.